Good afternoon, everyone. Thanks for joining us today. We have the pleasure of having some excellent panelists on our webinar today. So this is actually a series of educational webinars that we'll be doing for IP Global. And today we're going to be talking about creating a tax-efficient company structure and a very successful property portfolio in the UK. So just to introduce our panelists today, we've got William Page, who's head of UAE and Africa for IP Global. Myself, Andrew Salmon, head of Kenya. We have Anne Mubia Marungi from Viva Africa Consulting. It's the largest tax consultancy in Kenya. And Jeff Millington from Withers LLP, based in the UK, and their international tax and law firm around the world. So I'll introduce you now to Will, who will talk you through just a touch on IP Global and what we do for our clients.
Thanks, Andrew. Obviously, welcome everybody to the webinar today. So yeah, just to sort of start before we move on to the core subject of today's webinar, we will have a very short overview, just a little bit about IP Global. I can see already there's some names on there that we don't know, so there's some new people on this call, which is great. So good to meet you all. A little bit about us. I mean, effectively, IP Global is a property investment company that's set up to help clients all around the world buy investment property. The idea was born. Our founder and our chairman, still very heavily involved in our business, was in banking. Felt like there wasn't a company out there to give him some direction on where to buy and what to buy, and he was a very open-minded investor. And he saw an opportunity back in sort of 2005 and set up IP Global over in Hong Kong and Asia, and it's grown over the years to what we are today. So it's a good story. And the idea is that we can give people advice on the best opportunities, on what the risks are, and then we can provide the full end-to-end service to help with everything, right through to obviously helping with the taxation and giving people the connections to trusted people to help with taxes as well as part of the investment. So we'll just move on to the next slide. Thanks, Andrew. So we've got a global reach. We've currently in the 16 years that we've been around, we've invested in all these different locations. You can see our offices there as well around the world. We're currently up to 28 different markets, so 28 different markets across the globe. Being honest with you, we've kind of honed in on low risk markets, mature markets since the sort of last financial crash of 2008. The business model has very much honed in to low risk, mature markets where you can still achieve good returns, but in well regulated markets. So we're very active at the moment in the UK, which is obviously the core of what we do, but we're also active in Germany, which is a very interesting proposition. Some German cities like Berlin and Leipzig, and then we're also active in Portugal at the moment. Onto the next slide, please, Andrew. And really, this gives you a very short overview on what we do. We research the markets. We've got a team that go out and look for opportunities in different cities and different places, and then we underwrite. And when I say we underwrite, we actually commit financially ourselves to purchasing in developments that we bring to market. So we're financially invested ourselves as a company into what we bring. We also provide the end-to-end service. We provide the help with getting a lawyer to act for clients when investing. We have access to mortgages through our mortgage broking company, and we have a rental management business to make these properties income driven. And then we manage those properties and we help with the tax considerations throughout ownership. So it's very much end to end, and that's a very short overview. Just moving on to the next one, and there you go. That gives you an idea. We're over 5,500 units. Sort of, we call units is the word we use, but properties most people would use. That totals over $3 billion now invested in over 18 countries. So we've been around a long time, and we've got a good track record, and that's who we are. So just before we move on, I think Andrew's going to pop up a poll question, something Zoom has introduced, I think only recently, where we'd like to just ask the people on the call if they could fill in the question. I think Andrew, you're coming. There we go. I'm hoping you can see that now. And it's really just to see, we've got a series of webinars that we're holding over the coming few weeks, and we'll have a bit of information about that further in this slide. But it is asking you, if you do have a property now in the UK. We're very interested to know who's connecting with us at the moment in this world we're in, and if you could answer that question. And it's all confidential. That would just help us build a bit of our data and a bit of a picture about things of what's going on. But now that's done, and when you've answered that question, I'll hand over to the next speaker, and we'll field some questions at the end.
Great. I think we can end the poll now. So thank you very much for everyone that's entered in. And the next slide. So there is a bit more we just on to touch on here, Will. The underwrite model, but we can skip through that.
Yeah, we can crack on, Andrew, and get to the subject, I think.
Okay. In terms of the other webinars coming up, we've got one next week, 10 crucial truths about property investments. That's by our head office. And we have more coming up as well. So if you'd like to find out more about this, then please get in touch and we can invite you for these future webinars. So Anne, I'll leave it with you. Thank you very much.
Thank you very much, Andrew. I'll just start by very quickly, highlighting who we are. So Viva Africa Consulting is a Kenya boutique tax specialist firm. And basically what that means is that we just offer tax solutions and focus on tax matters through and through. So we've got a team of lawyers, of accountants, of economists, a whole dynamic to enable us to look at tax issues from both a financial and a legal perspective, to ensure that we're able to provide solutions to our clients that are viable. The basis for the creation of the firm was the partners did not want to create a firm that would stop at just the advisory phase. So we go over and above and help our clients implement the structures that we propose. We've been doing this since 2009 when we were formed, and we continue to do so through three key components of the firm. The first one being tax advisory, second being tax dispute resolution, noting that tax disputes have become a big deal in Kenya and in Africa as a whole. And finally, we do have a tax compliance docket that supports with the compliance side of taxation. Through these three spectrums, we've been able to interact with very many different segments and markets. And this is how we've ended up here today, supporting IP Global from the real estate front, where we have been involved in a lot of the major projects that have happened in Kenya, and we're able to also offer the support that's needed in Africa. I get the easy part of this, of this brief today, because I'm just providing the highlights from a Kenya perspective. And in providing those highlights, I chose to go about it in a very simple way, from a back to basics component. From a Kenya perspective, we have what we call the charging provision, and that's really what gives life to the income tax rights upon the Revenue Authority in Kenya. And Kenya only taxes on a source-based model, meaning that the Kenya Revenue Authority will only be interested in income that is accrued in or that is derived from Kenya. So if property is held outside of Kenya, it doesn't necessarily meet the test of having been accrued in or derived from Kenya. But having taken that, the first component from a tax perspective in Kenya is to determine the residency status of the person involved. So is it an individual? Is it a corporate? What are we dealing with? For resident individuals, we look at various tests to determine whether that person is resident in Kenya or not. From a Kenya residence perspective, we'll look at, is this from an individual's perspective? Does this person have a permanent home in Kenya or not? And if that person does have a permanent home in Kenya, then they are liable for taxation in Kenya, even if they step into this country for 1 day in the year. And there are various tests that are applied to determine whether that permanent home test is met. The second bit is, if one does not have a permanent home in Kenya, then they are typically deemed to be non-resident, but they do come to Kenya for specific periods of time. We'd then be applying the time tests, which are, how much time have you spent in Kenya? Have you crossed the 183-day threshold in a particular year? If not, we go back and look over the period of the previous 2 years and the current year. How does your time look like from a residency perspective? That then tells us whether Kenya will apply these taxing rights over the income that is generated. If one is then considered to be resident, Kenya will only tax on a worldwide basis on two components or two sources of income, and that's employment income and business income. What is the subject of the discussion today is property held outside of Kenya. Now, this property can be held in various models. So an individual can hold it personally, and that's a Kenya resident person holding the property directly as an individual, or we can have a Kenya resident company that holds the property in the UK, or we have a scenario where this property is held by an individual or an entity that is resident in the UK. The sources of the income that is likely in most of the cases we've seen to be generated out of that are, capital gains, rental income, or dividends from those types of arrangements. If we look at foreign source dividends from a Kenya tax perspective, those are not taxable in Kenya. If we have rental income that's been generated, it is not taxed on a worldwide basis as a result of it, as a result of which it would not be taxed in Kenya either. If we look at capital gains that are foreign sourced, again, those are not taxed in Kenya. So we'd effectively be looking at what is the tax position in the UK, where there is conflict in one way or another. There is a tax treaty between Kenya and the UK that can be used to resolve any tax friction in between. Andrew, could we please go to the next slide? Yes, so from a Kenya perspective, when we are dealing with an entity and trying to determine whether that entity is resident in Kenya, we'd be looking at whether that entity is actually incorporated in Kenya, whether the management and control of that company is happening out of Kenya, and whether it's been deemed by the Minister of Finance in Kenya to have been sole resident. Now, in practice, we've never seen the third component being applied. The first one is, pretty straightforward. If you do come and incorporate an entity here, then it is resident in Kenya. But the middle point, the management and control component, is a significant point because it works in the reverse. So we'd be looking at scenarios where a UK company has been formed in the UK and to hold property in the UK, but has its management and control components happening out of Kenya. Now, we've seen the Kenya Revenue Authority being quite aggressive over the last 2 years in determining the control of entities that are outside of Kenya. And so this is a key highlight which needs to be taken into consideration going forward. I've already touched on, foreign source dividends, gains, rental income. So from a Kenya perspective, Andrew, we are quite excited to be hearing from the next speaker on how all this would be impacting, would be impacted from a tax perspective in the UK. Thank you, Andrew.
Thank you, Anne. And I'll pass you now to Jeff.
Good morning, everybody. Just very briefly, I'm a director at Withers in our London office. It's an international law firm. We have offices around the world, 4 offices in East Asia, in Singapore, Hong Kong, Japan, and an office in Australia. We have offices in Europe and 7 offices in the US. We have offices in Geneva and Italy in Europe and various cities in the US and 1 in the BVI. We do both tax and obviously legal advice, and we cover all taxes and various legal advice as required. I think I just need to dive straight into the presentation if I can. So if you could bring the next slide, please. Thank you. So topics that I intend to cover today. Briefly, I'll look at the recent changes to taxation on UK residential property. We'll consider the structures to hold UK residential property in. We'll look at the inheritance tax considerations. I'll look at stamp duty land tax, which has become more significant over the last few years. I'll look at the various options on taxes on rental income, so in corporates or individuals. And finally, I'll just briefly look at the UK Residential Land Registry and just update you on that. And if I could have the next slide, please. Thank you. So then just briefly here on changes to taxation. So most of you, if not all of you, will be aware of these. From April 2015, the UK government introduced capital gains tax for non-residents selling UK residential property. Individuals who held property prior to the 6th of April 2015 and sold it after that date could look to rebase for costs to the market value at April 15. And a number of people did do that who've since sold property. Then in April 17, a long-standing protection was removed, which was the ability to shelter non-residents and non-domiciled individuals from inheritance tax on UK residential property. So historically, you would have held a UK residential property under a company, possibly underneath a trust, and whilst you would have paid tax on the non-resident landlord's rental income, you wouldn't have been subject to inheritance tax should the ultimate beneficial owner pass away. Now you are. So what that meant was that we had to restructure a number of trust holding structures as a number of individuals who were both settlors and beneficiaries of trusts suddenly had UK residential property in their estate for inheritance tax should they die. So those are the changes. If we could go to the next slide, please. Thank you. So do we hold a company? Do we hold properties in a company? And if so, is that company resident or non-resident in the UK? So what I would suggest is that if you hold it in a company, anybody who's looking to buy the property for cash, i.e. not for debt, would settle the funds into the company first for the company to then purchase a property. The 8-head regime would be applicable, but if all of these properties are held to rent, there is no 8-head due, and 8-head is the annual tax on enveloped dwellings regime. Applies to properties over £500,000. So the more high value properties, but can be quite expensive once you get into the very higher value properties. If it's rented though, there's no 8-head, but you do have to file a return every year and claim relief against the annual tax on enveloped dwellings. On the profits, we've got corporation tax. Currently in the UK, corporation tax is at 19%. The non-resident landlords regime was changed in April 2020, whereby companies holding property come within the corporation tax regime. This is new to 5th of April 2020 onwards, and it does have some implications which I'll consider on the next slide, please. So when we're looking at property ownership in a company, profits paid to non-residents can be paid by way of a dividend. There is no withholding tax in the UK on dividends paid out of companies. So if you have residential profits, once you've paid 19% tax on those profits, the money can be taken out should you wish to take additional profits out of the company by way of a dividend, and there would be no further tax on that. Corporation tax returns are filed annually. So if your filing date, if your accounting period is say the 30th of September, then you have until the following 30th of September to file a corporation tax return. You have 12 months. Payment is due 9 months and 1 day after the end of the accounting period. Expenditure, the change now with moving to the corporation tax regime for properties held in companies means that some of the expenditure which you have as an individual may not be allowed. The finance expenditure, interest, is subject to the loan relationship rules within a corporate vehicle, whereas if it's owned personally, then you can claim all of the interest deductions on personal ownership, whereas you may not be able to if it's held in a corporate. So it's something that you have to be aware of, and you would have to take specific advice on that. As mentioned, I'll bring this in, I'll talk about this in more detail shortly, but there is going to be, or there should already be in place, a UK register for beneficial owners for non-residents. It hasn't come into place at the moment. Whether it will or not, we'll see. Interesting conversation I had the other day about that, but we'll touch on that shortly. One of the things you might want to consider with family-owned companies is multi-shareholding. So if there's 4 family members, each having a 25% shareholding in the company, would limit the exposure to inheritance tax. Just in case you don't know, the nil rate band on which you don't pay inheritance tax is up to £325,000. So if you have 4 family members and you have property valuation portfolio of say £1 million, then you can quite legitimately be outside of any scope for inheritance tax. If I could have the next slide, please. Thank you. So on personal ownership, we have no ATED to consider. Tax rates are at marginal rates. So instead of a corporation tax rate, you're paying tax at 20% up to the first 50,000 of rental property, 40% thereafter, with, if you've got a big rental portfolio and a lot of rental profit, 45% rate of tax over and above £150,000 profit. You file returns in the UK declaring your rental income. The returns are filed annually on by the 31st of January each year after the 5th of April the previous year. And you make payments on account on your rental profits on the 31st of January and the 31st of July, with any balancing payments on the following 31st of January. The property obviously is in a person's estate for inheritance tax. Should just touch on capital gains tax. In the UK, if you sell a property now, obviously you're within the capital gains tax regime. You have 30 days to file a capital gains tax return and pay the capital gains tax. And I should add that's different from a company, because if a company sells a property and makes a capital gain, it reports it in the normal course of filing its tax return and pays for tax 9 months after the end of the accounting period. So on a capital gains, it's very much quicker from an individual point of view of declaring and paying tax. And again, the multiple personal ownership can limit exposure to inheritance tax. So but you do, if you are owning it between say 4 or 5 people, that does need to be reflected on the land registry in the UK. Next slide, please. Thank you. Inheritance tax. So the net value of a property will be subject to inheritance tax at 40%. Now, it's over 325,000 that you're subject to inheritance tax of 40%. And obviously you can reduce that exposure if you buy with debt. You have to be very careful though when buying with debt, because it has to be third-party debt, genuine third-party debt at the time of buying the property. For those of you who potentially have overseas portfolios, and you could borrow against the portfolio, so the bank might lend you the funds and charge that against the portfolio. Whilst that would reduce the value of the property subject to inheritance tax in the UK, the debt itself would be considered as what is known as relevant property. So that debt itself would be subject to inheritance tax. So you have to be very careful when looking at structuring. Mentioned previously that trusts and foundations are no longer perhaps the most tax efficient vehicles to hold property. They still can be. If you have funds in a trust and want to invest in a property or a foundation, you can do that, as long as if the settlor is not a beneficiary, then the property won't be in anybody's estate for the higher rate of 40% IHT, but you will have a 10-year anniversary charge at 6% on the net value of that property. So you have to weigh the two options up. And we have seen people buy property through trusts and foundations since we changed the legislation. Finally, one of the things that you can do, which a lot of people are doing, is consider taking out insurance cover to meet the cost of any inheritance tax, any future inheritance tax. Obviously, the younger you are, or the younger the people are who take out that cover, then the cheaper that cover is. If I could have the next slide, please. Thank you. So stamp duty land tax, there have been a lot of changes to stamp duty land tax over the last few years. There's a specific increase which isn't yet in play but will be in play from the 5th of April 2021, which has a direct effect on possibly most of the people listening into this webinar at the moment who are non-resident, and that's an additional 2% stamp duty land tax for all non-UK residents, and that's in addition to the 3% additional stamp duty land tax for people buying second homes. And it also applies to non-UK resident companies. It doesn't apply to UK resident companies, but the catch with a UK resident company is if you have two Kenyan individuals, resident individuals, who set up a UK company, the UK would argue that that company is non-resident because its ownership is overseas, so it would still come within the additional 2%. The previous additional SDLTs is 3% for second property, and that also applies to companies. So any company that buys a second property would come within the 3% additional rate. There is a higher flat rate for companies that do not rent the property out. Hopefully that wouldn't apply to anybody here, but that's a flat rate of 15% for any properties over £500,000. The only thing I would say on that is that we have seen a couple of individuals, or a couple of companies I should say, caught out where they have a big portfolio of properties. One of the properties becomes empty and there's no active actions being taken to rent that property out again, and it can sit empty for a few months. The revenue may take a view that it's no longer being rented and could come within the annual tax on envelope dwelling regime, and you could find yourself having to pay annual tax or tax under the annual tax on envelope dwellings. So that's more for the higher range, high value properties, and where you have a number of properties in a portfolio. So the stamp duty land tax is a significant cost for high value residential property. It starts, obviously the SDLT stamp duty land tax is 0% for the first 125,000, but by the time you add on the 3% for a second property and for 2% for non-residents, you have a 5% stamp duty land tax on a property of up to 125,000, where you then quickly go into 7% and then 10% by the time you're up to properties up to £925,000. So it is a cost that you have to consider, and you may want to consider multiple lesser value properties. It just depends on crunching the numbers yourselves. Could I have the next slide, please? So I think I've already looked at this rental income. Companies, as I said, is 19%, but we have no withholding tax on dividends. Personal ownership is taxed at marginal rates, but if owned through multiple ownership, you can really mitigate the rental profits. So for instance, a family that I discussed previously, you've got 4 owners. They had rental profit from that property, because it's a significant value property, of about £120,000–130,000 sterling a year. That in itself, you'd be paying 40% tax on £70,000 to £80,000 of that profits. By splitting it between the 4 of them, we bring our tax rate down to 20%, and we also have 4 annual allowance rates in the UK, and that's a £12,500 where you don't pay any tax. So the first profits of £12,500, you don't pay any tax. So we multiplied £12,500 annual allowance up to £50,000. So that you can reduce your tax rates in the UK if you're in a fortunate position to have a number of family members own the property. The downside for holding property in trust, if you're renting it, is there are high rates of tax on UK source income. You quickly move to 45%. I think it's the first £1,000 where you pay 20%, and thereafter it's 45%. Mentioned previously, capital gains tax on all residential property. Again, you can limit the exposure to capital gains tax if you had property prior to the 6th of April 15. If you hold a property individually, the tax rate's at 18%. If it's at a basic rate tax, 28% if in the higher rate, and in corporate it's 19%. If we could have the next slide, please. Thank you. So the UK Residential Beneficial Ownership Registry, this was due to come in January of this year, and it should affect all non-UK companies owning UK residential property. If and when it comes in, then any beneficial owner, the name and the address of that individual, it's proposed would be put on this register. There is talk in the last few weeks that this register may not come into play at all because of the transparency. There are concerns, certainly within some within government, of the transparency. So those rules may not come in. But we're waiting for an update. Personally, I think they will come in at some point. I think the registry will come in, but it may take another year or so. And just finally on that point, if non-resident companies do not comply with this register, then the company itself will not be able to sell or purchase any property. It'll be stopped from doing so until that information is provided. So there is there's an enforcement strategy there from the revenue. The next slide, which I think is the final slide, please. So conclusion, well, what we're seeing is despite Brexit, despite the pandemic, UK residential property is still holding up, certainly where we're looking at property not in the very high values. Rental returns have clearly been affected by the pandemic and the rental holidays, though at some point, if we're successful with the ongoing vaccination and we return to some kind of normality, that should come to an end. And the rental returns are quite good for UK residential properties. I've seen clients with some significant returns over the last few years, obviously prior to the pandemic. SDLT is and will continue to be a significant factor. You obviously have to consider the inheritance tax, the IHT. There are ways that you can mitigate what you have to pay. And you obviously have to be aware now that we have capital gains tax on residential property. I think that's all I wanted to go through. Thank you very much, Andrew.
Great, thank you, Jeff. That was great. I think we can now have our sort of question and answer session, and I've got a couple of questions that already come through. So one from Jonathan asking, what's the most efficient way to hold a UK property on behalf of minor children if the intention would be to transfer the property to children once they were adults?
On behalf of minor children?
The property and the children are too young to own, but the intention is to transfer it to them when they're old enough.
You're always going to have a capital gains tax issue when you transfer it to children. So if you're holding it on nominee for them, so my suggestion would be that you hold a property on nominee for that individual. The tax, if you're holding it on nominee for them, you can file a tax return for that individual. But obviously, if you're holding it on nominee for that child, then potentially before you might want to give it to that individual. So a child, once they pass the age of 16 and certainly 18, if you don't particularly want to give them that property at that time, because I've had an 18-year-old son, I wouldn't want to give him a property of his own at that particular time. If you don't want to give him a property at that time, or a daughter the property at that time, but you're holding it on nominee for them, they will have legal access to that property and there's nothing that you can do. So that's the downside of holding it on nominee. But if you hold it in your own name to give to them, or you even hold it in a company structure and you give them the shares of that company structure, you're going to face capital gains tax on that point as to when you gift it. So from a tax efficient way, probably the best way is through nominee. But if you're worried about them having access to that property and potentially being able to sell it and having access to cash, which you might not want to have access to, then you might want to look at considering holding it in your own name or a company name, but then you need to be aware of the capital gains tax when you transfer that property to them.
Okay, and so in terms, also another question is the brief overview of how UK capital gains tax works and what is the most efficient way to manage capital gains liabilities. And well, if you had,
it depends really. The capital gains tax liability is what the capital gains tax liability will be. So you buy a property. If you buy a property now for £200,000 and you sell it in 5 years' time for £400,000, you have a capital gains tax liability on £200,000 gain. There's nothing you can do to mitigate that gain. The gain is what it is. To mitigate the amount of tax that you pay is depending if there's a family of 4 or 5 and you own the property between you, then that gain split equally between you. There's an annual exemption allowance, which off the top of my head is somewhere around about £12,000 on capital gains. So again, you multiply that allowance out and you make use of more people's basic rate bands. The capital gains tax in the company is currently at 19%. And obviously it doesn't, unless you own it through multiple, even then it doesn't really make a great deal of difference. So the only way you can mitigate the tax due is through personal ownership and multiple personal ownership. There's not a lot else you can do on that capital gains tax, to be perfectly honest with you. That is what it is.
Is there a different treatment for capital gains tax if properties were held before 2015?
Yes. So if you held a property, if you bought a property in 2000 for say £200,000 and in 2021 when you come to sell it it's worth £1 million, you're not subject to tax on that full £800,000. You get the market value of the property at April 15, and that's the cost, your effective, that's your base cost. So the market value at April 15 is your base cost. So if that property had increased to a value of £900,000 in April 15 and was now worth £1 million, your chargeable gain is 100,000. There is another way that you can increase your base cost as well, in as much as you can work out what the gain is and attribute it over the months that it's been within the capital gains regime. That's slightly more complicated, and only on one occasion has that been more favourable than going for the for doing the market value at April 15.
Okay, and I think I've got another question which might be more applicable to Will. Where can we, in terms of IP Global's sort of markets, where could you buy a property without paying capital gains tax?
Well, it's been very useful. When you talk about tax, it's always very difficult to be positive, isn't it? I think the thing to sorry to Jeff to give you a dig there, but it's all very important stuff. But it's I think the key thing here is that the majority of what we do, I'll just turn my camera on. The majority of what we do is in low risk regulated markets, and when you're investing in those markets, there are going to be tax liabilities. You know, there's going to be potentially income tax liabilities, entry tax, income tax liabilities, as well as capital gains tax liabilities. The only country that we do where there is a benefit is Germany. So if you were to buy a property in Germany, then if you hold that property for 10 years in Germany, there would be no capital gains tax. There's an exemption, but obviously that's dependent on where you're resident. So if you're resident in a tax environment, you'd be bringing that gain obviously back into the UK, for example, and Jeff would need to declare that for you if he was your advisor. So, you know, that's worth bearing in mind. But on the subject of tax, you know, if you're wanting to invest in good quality property, you're not wanting to take huge risks, then ultimately, apart from Germany, you know, there are going to be some liabilities, but you can be clever, and as Jeff explained, you can, you know, own a property 4 ways and take advantage of your annual exemptions. Andrew, there's too much. Do you see all the questions? Because Zoom is a clever system, but I see a question from Steve that we said we'd answer. Do you see that?
I unfortunately I can't actually see the question and answer the questions.
Okay. Well, I've got, because there's one popped up on my screen. I don't know. It's from Steve. So it's a couple of questions, I think, for Jeff. Question 1 from Steve: do non-residents also get the UK additional nil rate banding for a property of £175,000?
No, because invariably it's not going to be their residential property. So you only get it if it's your residential property. So no, you don't, I'm afraid.
Thank you. And then the next question from Steve: if a property is held in a limited company, which is a way that we see quite a few investors at the moment holding property for various reasons, can the limited company, and this is where I need your help, can the limited company make an employer's contribution to a pension scheme, thus preventing tax due in the resident country of the buyer?
Just preventing tax due in the resident country of the buyer. I'm not quite sure if you're talking about, can you limit your corporation tax liability by making contributions into a pension scheme? You'd have to have an employee of that company, and that becomes quite complicated. So I think I'd need to understand a little bit more what's behind that, because I don't understand the second part, thus preventing tax due in the resident country of the buyer.
Okay,
so,
well, we can take Steve's. We can connect Steve to you, Jeff, for sure.
Yeah, I'm not,
and see if there's see if we can understand the question.
Still take advantage of an EIS scheme to defer CGT liabilities in the UK, not in respect of residential properties, as far as I'm aware. You can't know. And EIS is, I very much doubt whether a residential property would ever come within an EIS scheme.
Interesting.
I mean, I've not seen one. I've never seen a residential property portfolio come within an EIS scheme. That's not what EIS was set up for.
Very good. Well, yeah, thanks for the input there, Jeff.
And if there are any questions that we haven't answered, I'll make sure that we get back to you on that. But I think we can thank everyone, for all our panelists. Thank you very much, Jeff. Thank you, Anne. That was really great, really informative. And thank you everyone that's on the webinar today, and thank you very much, Will.